The venture capital market is dying. Just last year, 3,200 growing startups shut down because they couldn't secure further funding. The world will no longer see companies like IRL that raised $200 million, IronNet raised $400 million, and Convoy raised $1 billion, and many others. It's reached a point where VCs are investing in a startup that helps other startups go bankrupt. Does this mean the end for the VC market? And what should venture startups do? Find out in this video. Don't forget to subscribe to find new videos on this channel. Let's start from the beginning. In 2023, VC investment totaled $170 billion, which is $70 billion less than the previous year and $170 billion less than 2 years ago. The VC market has been in a deep state of depression since Q4 2021. The number of investments have been steadily declining quarter by quarter. To understand why this is happening, let's explore how the VC market works. Think about it in this way. Seed investments form the base, and IPOs sit at the top. The goal of investors at each level is to find startups that will be able to advance to the next stage. Later investors compensate for earlier investors' failed investments through higher valuations. At the very top of this pyramid stands the IPO, where retail investors bear the cost of everyone's mistakes below. IPO market. However, the IPO market itself is currently in deep trouble. In 2023, the number of deals is 6 times less than in 2021, and the total value is more than 12 times lower. This indicates that not only has the number of IPOs decreased, but valuations have also dropped even more significantly. IPOs that are happening are occurring at significantly reduced prices compared to previous rounds. For instance, Instacart's valuation at its IPO was 75% lower than its previous round, CNBC. And Klaviyo dropped by 13%, claims Bloomberg. This means that late-stage investors cannot go public, IPO, without facing a down round, which would result in financial losses. Consequently, early-stage investors also struggle to achieve their returns. This creates a broken investment cycle. First, investors cannot retrieve their money. Next, profits cannot be distributed. And thirdly, there is no reinvestment in new early-stage projects. And you might wonder, we still see some deals happening in 2023 and 2024. This was a question for us too, and we decided to talk about it with an expert who knows the current situation more than anyone. We spoke with Yakov Filipenko, founder of the networking platform Intch. Last year, they won a startup competition and stood on stage with the prize. At the end of last year, Yakov traveled across the states to speak personally with familiar investors. His understanding of the situation is that the VCs who raised money before the market downturn have adopted a wait-and-see approach. Apart from AI-related projects, given the market conditions, they hesitate to invest due to doubts that projects can secure the next round of funding. They support their growing portfolio projects because these projects cannot achieve reasonable valuations on the open market, and the current investors want to avoid down rounds. This is exactly what gives the impression that the market is not completely dead. Meanwhile, those funds that fail to raise money have gone into hibernation mode. It seems that investors and their LPs have money but no faith in the market. Therefore, we can postulate that even if the VC market isn't dead, it is definitely in dire strait. So, what should early-stage entrepreneurs who are either not yet profitable or just breaking even do in this scenario? We considered this question at the end of last year. The basics are clear. You need to cut costs to extend your runway. This is the unpleasant part, but the key question is how to continue growing. So let's continue with the positive news. If your project is still alive, then first, you likely have fewer competitors now. Many of them can't survive without funding. Second, many highly skilled professionals are now available to you. The first point is important because it means less competition for your target audience's attention, lower advertising costs, and so on. But the most crucial aspect is the second point. One of the primary goals of a startup, assembling an A team, has now become much easier. Amid a wave of layoffs, many top professionals are seeking part-time projects as a safety net. This means you can access access their expertise for just 25 to 30% of a full salary. This approach helped Intch reach profitability and growth, and it could help you too. Moreover, they created the Intch service to help you find such professionals. Here's how it works. You describe your current task. Other founders who have already tackled similar challenges share their approaches and recommend experts who help them achieve results. Link to the service is in the description.